Okay, welcome everybody. We are going to do a quick lesson on options. Okay. Now, let me switch to just a blank chart. So, all right. All right. So, what is an option, guys? Um, yes, I am recording. I am recording. I don't see Oberon, but we'll give him this replay if he jumps in. Um, so, an option is simply a contract, right, between two parties. It's the buyer and the seller, right? Now, what does an option look like, right? Like, what do you buy? What are you agreeing to? So, usually you have an expiration date, right? And I'm trying to get my pen out here. We call those ones that happen on the third Friday just monthlies, right? So, you've got January 5th, January 12th, and then January 19th, right? These are your monthlies. You've got an expiration date, you've got a strike price, right? Which is right here in this middle column here, 500, 400. And what you're doing is you're saying, hey, if I do buy one of these, it gives the buyer the right to, depending on what you buy, a put or a call, to buy or sell that underlining asset at that particular strike price. And one option represents 100 shares. So here, we'll just use NVIDIA. If I were to buy January 19th, right, that's what I'm selecting right here, which is January monthlies. Let's say I wanted to buy the 500s, which are right here. Is this too small? Are you guys able to read that? Can you guys tell me what price that would be? How much does the January 19th $500 call cost? It costs 1965, right? 1980, somewhere else. Let's just round it up to $20. So, how do we determine what our break even would be? If I wanted to know what my break even is going to be, what would I need to do? Well, I would have to add what I paid to the strike price. Right? That's it. So if NVIDIA by January 19th is below $520, I'm going to lose money. If it's above, I'm in the money. Right? Does everybody understand that? Yeah, William, exactly. That's the exact definition. 100%, right? Now, as the seller of an option, if I'm selling this, I'm thinking it's going to be below $520, right? So, if it's below 520, the seller's in the money. If it's above 520, the buyer's in the money. Okay? Now, if we were going to do a put, if I was like, you know what, I'm going to buy a $500 put because I think it's going to go down, right? We buy calls because we think they're going to go up. We buy puts because we think it's going to go down. Well, then what this means is as a call, I have the right to buy NVIDIA at $500. I'm paying $20 for that right. Well, as a put, I have the right to sell NVIDIA at $500, right? And I'm paying $20 for that. So if I was buying a put for at 500 for $20, what would my break even be? Yeah, it's 480, Ice Veins. It's 480. So it's flipped, right? 520 on the call side, but on the put side, it's 480, right? So the way you calculate your break even is what you paid for the contract minus your price, right? So here, let's make it a little bit simpler. So last week, I told you guys, hey, I'm buying some Amazon. You guys remember? I'm buying some Amazon 149 calls, right? Is this readable for you guys? Can you guys read these letters? I mean numbers, I'm sorry. So this is what I paid for it, right? So I bought this call, right? For $1.22. So can you guys tell me what my break even is going to be? JOST, can you tell me what my break even is going to be? Because all I need to do is take my strike price and then add what I paid for it. So what's my break even for Amazon December 22nd? 149 calls. Yeah, exactly. Exactly. It's 150.22.4. Yep. So again, you just add that number to that number, and that gives you your break even. Does that make sense, Just? Okay. Any questions on this so far? Oh, let's see. Calls are easy for me. I didn't see that question you responded to. Calls are easy for me. Puts confuse the hell out of me. Okay. So on the put side, it's the same exact thing but flipped, right? So just think of it this way. A call gives you the right to buy the stock at that price, and a put gives you the right to sell the stock at that price, right? So if I would have bought this 149 put, and it drops to 140, well then I'm good. But because we're so high, we're well above it. I don't want to sell my stock at 149 because right now the Amazon stock's at like, what's Amazon at? 152? So I can sell it higher now. So that means that put is worthless. Unless there's time attached to it, right? The break even on that's going to be whatever you paid minus 142 instead of adding. That's it. Does that make sense? And so if I were to buy a put for $1 on Amazon, put, let's say 150, and I paid, I'm just gonna make it easy, $1. Well, then my break even's 149, right? Anything under 149, then hey, I'm in the money, right? Let's go. Okay. Yeah, great point there, Mr. Rogers. He says buying an option does not obligate you, but selling an option does obligate you to buy or sell or whatever it is, right? Okay, now why do people trade options? Does anyone know? What's the main reason people trade options? Yeah, yeah. Leverage. My little girl's in here now. Let's see if she knows what leverage means. Do you know what leverage means, sweets?
No.
Okay, so what leverage means is, in this particular instance, I can do more with a smaller amount of money, right? And so, what this allows you to do is say, you know what? If I wanted to buy 100 shares of Amazon right now, how much is that going to cost me, guys?
It's like a lot of money.
So let's just say it's 152. It's 152.50, but let's just say it's that. Well, how much money is that gonna cost me? Right, it's gonna cost you. Just add the 2 zeros, right? That's what it's gonna cost. But if I wanted to buy Amazon, let's say 155 call. So let's go Amazon or even 150. If let's say we wanted to buy 150, either one of them, we could buy the weekly. Excuse me. So the weekly 155 is $1 basically. It's 93 cents. So we could come in here and we could be paying 93 cents to control 100 shares. So we're paying, move that decimal place over twice, right? So we're paying $93 to control 100 shares of Amazon instead of 15K. And if you wanted to buy the 150, you're still there it is. You're only paying $350 for it, right? So you're paying $3,000. So it allows you to use a smaller account to make more money, right? Now, what are you trading off? What's the risk? Why can you do that? What's the trade-off? Yeah, the trade-off is time, right? There's a limited amount of time, right? And that's what we call what? Right? And so when you come over here and you look at the option chain, which is what this is called, you can come over here and you can look at how much your stock's going to be affected every single day by you holding it. It's going to be going down because it's a time. Time is never going up, it's always going down, and so your theta is always working against you unless you're the seller, right? Okay. Now, one of the things that I want to really explain to you is what I do a lot of times is I sell options through earnings. And the reason I do that is because what's called intrinsic the IV, the intrinsic value, the implied volatility is is gone up. You're expecting bigger moves towards earnings, right? And so what that means is your implied volatility is like this, and then earnings are coming up, and it gets higher because you're expecting a big move. And one of the things I want to get you guys to understand here is what waiting for a TTM squeeze does for you on an option. So when you're expecting a big move, right? When you're expecting huge moves in the underlying asset, then the sellers start pricing in higher pricing for the option. So do you guys see all of these E's right here? What happened right after these E's? These E's are earnings. Like, what happened to the volatility? So this is a graph of the volatility, right? So as soon as earnings happens, what happens? Boom, big drop. Big drop. Because we got the move, right? We got the move that we were pricing in. There's always this big drop, right? And so think of this chart when you think of the TTM squeeze. Because what happens is, or the TPS pattern, or whatever we call it. Whenever we get into a squeeze like this on Amazon, what is this telling us? All it's telling us is price action has been consolidating. As price action consolidates, IV goes down because the past price action hasn't been going crazy. It hasn't been doing this. And so one of the beauties of this system is, hey, let's wait until the options have low IV and then buy them. And then if it shoots up, guess what happens? Not only are you getting price, but you're also getting IV, because now you're starting to have to price in bigger moves. Okay? So that's one of the things. I know it's not a basics, but that's one of the things that I wanted to share with you about it. Okay? So that's the beauty of this TTM squeeze. Now, let's just break down the option chain real quick. Right here it says open interest. Does anybody know what open interest means? Yes, and what I can tell you, and anytime you see somebody talking about continually buying directional calls or puts through earnings and claiming they're making profits, they're lying to you. That's a big warning sign. If anybody says, "Hey, I'm buying calls, I'm selling puts, I'm doing this," and they're always making money on these things, they're lying to you. Okay? So just beware of that, because I've seen that happen in many different places. And the statistics are just not with you. Now, is there times to buy calls through earnings? Sure, yeah. But you're playing against the averages. The averages are heavily against you at that point. Now, if you buy stock and sell premium, right? That's what I do. I buy stock and I sell premium against it. Why? Well, guess what? If we stay flat, I make money. If we go down a little bit, I make money, right? But just anyway, beware of that. Yeah, so open interest is open contracts. Frank, that's correct. Open contracts win, Frank. What is this telling us? The contracts open at what? Yeah, they're not settled at what? What's the time frame we're talking about? Does open interest include total volume? That's what I'm getting at right here. Right? Open interest is telling you at the start of the day. It's not now. It's not now. It's at the start of the day. It's not including, it's not at the moment. No, it's not at the moment. Yeah. So volume, total volume is this day, right? So open interest is at the start of the day. This is telling me, so if I were to look at Amazon's 155, right? Amazon's 155 says we bought 40,500 today. But open interest is only 16, right? So obviously that doesn't include today. So at the beginning of the day there were 16,000, but 40,000 were bought today. Right? So what that's saying is at the start of the day there were 16. There's been 40,000 bought. Let's just pretend we're going to end here. If nobody else sold their options today from the open, let's just say it was 16K, well then how many would be there at open interest tomorrow? Well, it'd be 56K, right? You just add the two together. That's what would be there tomorrow. I'm actually going to change this color to yellow so it's a little bit easier to see. So if you add 16K plus the 40K sold today, and you're sitting at 56K, right? That's what you'd be sitting at. And one of the things that I do, again, not to kind of get off on a tangent here, but I will keep track of big dogs buying and selling way out in time, right? So if I see a huge, you guys will see me posting here, somebody bought a Microsoft order, for 400. They paid $7 million for it. They bought 2,000 contracts. There's only 7 open interest right now, so that means tomorrow there should be 2,007. And then tomorrow I'll look to make sure that they're still holding it. And if they are, it's like, okay, so they're holding this. Maybe this is something I want to look at, right? Maybe they know something I don't know. And so you can kind of keep track of these big dogs that are buying through open interest. Okay. So, open interest, total volume, you get that. Now, the bid-ask, we're just going to go through the bid-ask right here. Just so you know, one of the things that happens, and it's so hard for me to trade in the mornings, is you get these bid-ask spreads. So like this morning, here, let me show you the chart. Remember, I wanted to play the 150 option, this weekly option, and I wanted to buy it straight out the gate. So what did that look like this morning? Sorry, I'm trying to zoom in here. So this morning, there was a low of $1.96 and a high of $2.44. So think about that. Think about the percentage there. It goes from $2 to $2.50. That's a 25%, right? No. 25% would be $1. So that's a 12.5% range, right? 12.5% is pretty big range, right? So for me, I see this and I'm like, maybe we'll get a quick drop and I can get my 175s filled. We did not. I was buying up the shares of the stock, but I did not get filled on my options because you had this huge bid-ask spread. And so what you have to be aware of a lot of times is, especially in bigger companies, like let's look at Melly. You can have really big spreads. So like look at this. You've got a 21.60 by 23. You got a $2 spread on this at the money, right? And so you just have to be aware of the spreads because you can literally eat up all your profits with that. Okay? What did I say, DDT? You got big... I didn't say big AWS spreads, but what did I say? I don't know. Okay. Has the contracts been executed with open interest? Yes. Well, I don't know what you mean by open interest. Those have been sold, right? But they haven't been closed out. So at the beginning of today, we had 14,141 people or contracts open on the Amazon 160 that closes this week. Big ask. Oh, that's what I said. Oh, that's funny. Big ask. That's why that's my southern slang. I don't have that proper enunciation. Oh, man. Okay, so does everybody understand open interest, total volume, bid ask. Any question on this? And again, this whole thing right here is just called the option chain, right? This is where you go to find it, right? Okay. You enunciate fine, but I do like the. Okay. So the next thing that I want to go over is premium. Do you guys know what premium means? So if I'm a seller or I'm a buyer, it means different things, right? So if, let's just say on AMD, do you guys remember what I sold last week on AMD? So here, I'm going to take this out, and I'm going to use this timestamp, okay? Can everybody read this right here? Is that readable for you guys? So here's the timestamp that I was selling these at, right? So I was selling these around 3 o'clock on 12/13, right? And I was selling 141s. And so you come over here, you go to AMD, and you look at these 141s, and you go back and we're gonna look at the daily. I mean the I gotta take out the after hours. We're gonna go back to 12/13. Okay. And so I was selling these AMD contracts for around $2.50. Okay? So, whoops. Go back to the option chain. So, here's the quiz. You ready? You guys tell me. Let's see, $508 right here. As a seller of options, what was my break even? All right, we got two different answers, and one of them's correct. Okay, what you guys have to take into account here, Billy, why is Billy right? You guys tell me, why is Billy the correct one? And the reason Billy is Billy is correct, guys, is because I am the seller. So I'm the one getting this premium. I'm literally getting this premium. So somebody's paying me $2.50 to buy AMD at 141. So because I am the seller, then I take that price and I add it to it. Right? So does that make sense? Everybody had the wrong answer but Billy. So let's make sure we go through this again. I use this week, Hankus. That's why Billy sits in the front of the class. You ever seen Billy Madison? Billy, move to the front of the class. So again, guys, as a seller, I'm taking premium. And again, this is why I sell through earnings. It's because I want to get all that premium. Right? And so as long as AMD is under 143.50, I'm in the money. Now here's the next question for you guys. You ready? Is there a way I can erase all this? No, I'm just going to re-snip it. The expiration is this week, right? Calls. See how I say calls for next week? So this was last week. So what I'm going to do now, guys, what happens? Let's just pretend I don't close any of these options and I hold them all the way through expiration. What happens if AMD closes at 150 at the end of the week? What do you think's gonna happen? Dude, I love that. That's one of my favorite lines, William. Oh, I love it. You want some of this milk, Sideburns? She goes, no milk will ever be our milk. And he's like, want some of this milk, Sideburns? I love that movie. Oh, man. Yeah, exactly, Hankus. I must sell him those at 141. Right? So how much money would the buyer of this option make? On just one contract, right? So remember, I got a 250 credit. Whoa. Right? So his break even is the same as my break even, right? So 143.50, right? 143.50. And the difference between these two. Does that make sense? And so 143.50, 144, 145, 146, 147, 148, 149 plus 50 cents equals 650, right? So Joe S. and Cheryl, they got it. And Billy, they all got it. Chris, right? Yes, exactly. 900 minus the 250 that they paid. Okay. Now, what happens if... Let me get a new snip here. Uh-oh, I lost my alert. Oh, there it was. Okay. What happens if AMD closes this week? Oh, you know what? I'm not using my EpiPen. I'm gonna start using that because I can erase it. So if AMD closes at 140.99, what happens, guys? Yeah, expires worthless, right? I keep that money and I'm like, woohoo! You idiot! You bought my option and I took all your money, right? Yay! I took $250 out of this guy's pocket. Yay for me, right? So I'm happy, and I keep the shares, and I'm gonna sell some more calls against it next week, right? Woohoo! All right. Well, what happens, guys, if it closes at 142? What happens then? So what happens right now is whoever bought my option, excuse me, they have the right to buy AMD from me at 141. They can exercise that option if they want to, or they don't have to. Odds are they will, right? And so my options get called away from me at 141. That's where he bought them from, right? So did the buyer make any money? Is the buyer taking my shares and making money? So as the seller, you're not the one assigning it, right? So as the buyer, right, you're going to get automatically taken on these. You're right. So if he does take them, he owns AMD at 141 plus his premium of 250. Right? And so he can sell it as soon as he gets it at 142 and only lose $150. So he only loses $150 instead of $250, right? Does that make sense? Any questions on this? And so this is what premium is. And this is the beauty of using the covered call strategy. So on AMD, why did I sell 141s? Anybody tell me? Again, this is what I do with all my long-term positions. I always do covered calls and occasionally naked puts. Well, let's go back to AMD. Looking at AMD, and I was looking at the chart, and I said, you know what? I personally think AMD is going to give us some resistance, right, into this zone, into this 140 area. I think it's going to sit here and consolidate. It may go higher, it may go lower, but I think by next week, I'm going to be in the money. I think. Right? Well, what's the worst case scenario for me since I own the stock? Since I own the stock, what's the absolute worst case scenario? Chris, I do that all the time. Yep, I do it all the time. Yeah, called away. And what is my sell price? With premium and everything, with everything priced into it, right? Worst case scenario is I sell and my cost basis on that sell is the 141 plus the 250. So it would be like I'm selling the shares at 143.50. Well, guess what? I've already got a sell order up there anyway. I was going to sell there anyway. So why don't I just, instead of just selling there, why don't I just put in a covered call in case it doesn't reach that level? And I'll take some premium if it doesn't. And if it does, great, they're taken away. Does that make sense? Okay. What happens if it drops? Well, then I just keep the premium, Daryl, because I sold to open. I get a free $250. Now, if it drops to 100, I keep the money in my shares, right? Now, if I'm a seller of puts, Daryl, if I sold AMD, let's say I sold a put at 120, and it drops to 0, then yeah, you're screwed, right? You're down $120 per share. That's the risk factor, right? Okay, does everybody understand premium, break even, and all that kind of stuff? Let's see. Nate just put out a trade here. Let's see. NVIDIA 12.22. So this week's 520 calls. So he's looking for a 500 break here. Give me one sec, guys. Can anybody tell me the difference between this one and Costco? I like the idea. I like the play, and I'll play it with them. But can anybody tell me the difference? You're holding one call, make it go up. Yeah, I'll try. I'll try my best. The the difference here is that Nvidia's actually already broken over 500. Right? We already broke and then failed. So you had that double top fail. And a lot of times you guys will hear me talk about making a little U, and that's exactly what happened here. And so now it looks like it wants to go back up and crack this 500 and actually break through. So in my opinion here, I don't think a failed break. How do I say this? I think if we do crack 500, I think your odds of pushing further, like maybe 520, are much higher. I hope that makes sense. So let's see. NVIDIA, so let's just look at these. 520 this week. We're paying $1.90 for them basically. So guys, you guys, with this lesson, what is our break even? If we were to hold these, we're not, but if we were to hold these to the end of the week, what is our break even? Yeah, exactly. 521.90, right? Now, here's the kicker. Since we're not planning on holding them, for you guys that are a little bit more advanced, what happens to this if Nvidia goes up $1? What's this going to be worth if Nvidia goes up $1 from here? What's it going to be worth? What tells us that? Yeah. So what lets us know if it goes up $1, this is how much it's going to go up? Yeah, it's 17 cents, right? Can't read it? Yeah, it's the delta, right? So as this goes closer to being at the money, what happens to the delta? Well, the delta goes up, right? So right now it's 17 cents. If it goes up a dollar, your delta is probably going to be near 18 cents. Then if it goes up another dollar, it's going to be closer to 19 cents. And then if it goes up another dollar, it's going to be closer to 20, 21 cents, right? So your delta starts getting higher and higher. And so one of the reasons that I buy deep in the money calls on long-term picks like AMD, BABA, and stuff like that is because I want high delta, and it's a way for me to own the options, but not pay as much as it would be to buy the calls. Does that make sense? So that's why I buy deep in the money stuff on longer term plays. And even on this one, like if you're like, hey, you know what? I think Nvidia is going to break over 500. Well, if you really think it's going to go to 520, why not buy the 500? Well, the reason is because you're risking $7.25 versus $2. All right? Okay. Okay. I think this was a good basic discussion. It's about 15 minutes before PSU, so I'm going to cut this recording off. Does anybody have any questions before I cut it? Okay, hope you guys enjoyed it.